First of all, it's not predicting anything. It's tracking current trends. And what we do is we assume that these trends will continue. And RRG will show you that rotational character of markets. And what we see is that these trends usually go into a rotational sequence from outperformance through underperformance and back to outperformance. And we see that in all the markets. So RRG is perfectly suited to give an investor a high-level overview of how a market is behaving. Yes, I mean it's not only for RRG, but basically any technical indicator or any form of technical analysis requires a high degree of liquidity, because what we do with technical analysis, we try to capture the behavior of the group, behavior of the crowd, and if it's a thinly traded, illiquid market, then that's only a small group of people trading that stock, and the odds of that small group changing their mind is obviously a lot bigger than the big group that is trading highly liquid stocks changing their mind. So liquidity is crucial for the reliability of technical analysis, I would say. Oh, the index levels, so the Nifty and the sectors are definitely liquid enough. When it comes to individual stocks, I believe that the Nifty 50, these are definitely worth looking at from technical perspective. Below that, I mean, I'm not a super expert on the Indian markets, but what I've heard is that there are a lot of small cap stocks here, so you got to be a little bit careful with those. What I usually try to do is, if I want to take a technical take on a small cap stock, I switch to a higher time frame. So instead of looking at a daily chart, I look at a weekly chart or maybe even a monthly chart. Because when you look at a daily chart, you have a small group of people. If you look at a weekly, then you got like 5 days. So that's a bigger group, and a monthly is an even bigger group. So you pretty much create your own liquidity by lengthening your time frame, and then you can still spot trends. Well, I mean, asset allocation should be at the core of every investor. I mean, if you trade in stocks, it's very important. Well, I mean, it's much more important to be in stocks than it is to be in a specific stock. So if the stock market goes down, pretty much all stocks go down. So the decision to either invest in stocks or another asset class like bonds or commodities or real estate is at a higher level and has much more impact on your overall performance than whether you are in stock A, B, or C. So asset allocation is a big driver of your returns, and RRGs can help you make those decisions, because you can plot those RRGs for various asset classes against some sort of common denominator. So you can plot stocks, bonds, commodities, real estate, all on one graph, and then you can see the same rotational pattern as we've seen in sectors or individual stocks. You mean the short-term trader, like day trading type? Only if you have enough money and enough time, then do it. Otherwise, I think it's a lot better to take at least a little bit longer term view, because these trends, they need time to establish and to mature. They are there during the day, but only, the amount of profit that you can make is a lot smaller. So you need a lot of money and a lot of trades to make that work. So if you have a lot of time, deep pockets, and maybe super fast computers, and you're a super good coder to pick up these trends, give it a try. If you're still in school or a student and you do it on the side, just do yourself a favor, take a little bit longer term view, and just sleep well at night.